When you think about a successful company, what's the very first thing that pops into your head? It's profit, right? That all-important bottom line. But what if I told you that focusing only on profit could actually drive a company straight into the ground? Well, today, we're going to dig into why that is and what a truly healthy business looks at to measure its success.
All right, let's just kick things off with a question that seems, well, kind of crazy. Can a company that's making a profit actually go bankrupt? It sounds totally impossible, but the answer is a resounding yes. And understanding the how and why behind that is one of the biggest lessons in strategic management. So stick around because we're about to solve this puzzle together. So, to really get to the bottom of this, we've got to look at the tools companies have been using for ages. And one of the real heavy hitters in the world of finance, a method used for decades to decide if a project is worth investing in, is something called net present value. You'll probably know it as NPV.
Okay, so what is NPV, really? Let's break it down in simple terms. Imagine this. Would you rather have $100 today or $100 a year from now? You'd take it today, of course. You can invest it, earn some interest. That basic idea is called the time value of money. Well, NPV is basically just a fancy calculator that takes all the money a project is expected to make in the future and tells you what all of that is worth in today's money. It answers one simple but powerful question. Is all that future cash worth more than the money we have to spend to get it right now?
Now, this is why NPV has been the gold standard for so long. And for anyone studying for the SCMPE, you're going to want to pay close attention here. These are your exam keywords. First and foremost, NPV has a direct link to maximizing shareholder wealth. That's keyword number one. Second, it nails the time value of money, the concept we just talked about. Third, you can adjust for risk, which is huge. And finally, it considers all the cash flows over a project's entire life. You nail these points, you're going to get the marks.
But, and this is a big but, NPV is not some kind of magic bullet. It has some serious blind spots. For one, the math gets really tricky when you're comparing projects of different sizes. But here's the real kicker. NPV is built on a house of cards. It's all based on assumptions. You're guessing about future cash flows, you're guessing about the right cost of capital, and if those guesses are wrong, your whole calculation is basically worthless.
And that, right there, brings us full circle to our opening puzzle. This quote is the key to everything. See, profit, that's an accounting number. It can include sales you've made but haven't actually been paid for yet. Liquidity, on the other hand, is about cold, hard cash in the bank. You can be profitable on paper, but if your customers don't pay their bills and you can't pay your employees, you're done. That's a liquidity crisis.
So you're starting to see that the problem isn't just about NPV. The real danger lies in any performance system that only looks at financial numbers. Let's talk about why this narrow, numbers-only view can be so incredibly dangerous for a company's long-term health.
This slide just lays it all out, doesn't it? When you only focus on financial metrics, you encourage short-term thinking. Managers start doing whatever it takes to hit this quarter's numbers, even if it hurts the company down the line. These numbers are also all about the past. They're historical. They tell you how you did, not where you're going. They're also internally focused, often totally ignoring what's happening with customers or competitors. And yeah, they can be manipulated, a little window dressing, to make things look a bit prettier than they really are.
Okay, so if the financial-only view is broken, what's the fix? How do we get a clearer, more honest picture of what's going on? Well, this is where a much more modern, holistic approach comes in, using something called non-financial performance indicators, or NFPIs for short.
So what in the world are NFPIs? Honestly, they're just measures that look beyond the spreadsheet. We're talking about real-world stuff, like customer satisfaction scores, how often your employees are leaving, the number of defects in your products, or how long it takes to bring a new idea to life. They give you a much richer, more complete picture of a company's actual health and its potential for future success.
You know, the goal here is all about balance. The best way to think about it is like you're driving a car. Profit, that's your speedometer. It's telling you how fast you're going right now, and yeah, that's important. But you can't only look at the speedometer, right? You also need to check your fuel gauge. That's your cash, your liquidity. You need to check the engine temperature. That could be your employee morale. And you've got to check your tire pressure. Maybe that's your customer satisfaction. NFPIs are all those other critical gauges that make sure you actually get where you're going.
This all sounds great in theory, but how does a company actually do this? How do you put it into practice? To figure that out, let's step into the shoes of a consultant for a minute and look at a real-world scenario. So let's meet Light Automobile Limited, or LAL for short. Senior management, They're all in on these new non-financial indicators. But the department heads, they're skeptical. And you know what? They're asking the right questions. How does this help me manage my team? How does this actually improve our product quality? How is this going to help our brand? They need a real plan, not just some fancy theory.
All right, let's put on our consultant hats. For the HR manager, we'd say let's start tracking employee turnover and how effective your training programs are. For the head of operations worried about quality, we're going to measure defect rates and the number of customer complaints. For the marketing team, we'll track brand recognition and what people are saying about you online. But here's the absolute key. Each of these is a leading indicator. If employee turnover starts creeping up today, that means higher costs and lower productivity tomorrow. More product defects now means fewer sales later. By tracking these NFPIs, LAL can see problems coming before they wreck the bottom line.
Now, as powerful as all this is, it's not a perfect science. Implementing NFPIs comes with its own set of hurdles, which you could call the qualitative conundrum. Think about it. Unlike a clean, simple profit number, stuff like customer feedback can be pretty subjective. It's hard to compare customer happiness this year to last year in a perfect apples-to-apples way. And just the act of collecting and sorting through all this info, well, it can be expensive and take a lot of time. It's a powerful approach for sure, but you have to go into it with your eyes open.
So, let's pull this all together. This slide gives us that perfect side-by-side. The purely financial view, it's short-term, it's backward-looking, and it's incomplete. The balanced view, the one with NFPIs, it's long-term, it's forward-looking, and it's holistic. It's really the difference between trying to drive a car by only looking in the rearview mirror versus looking at the entire dashboard and, the actual road ahead of you.
And that just about wraps it up, but before we go, especially for our SCMP viewers, let's do a quick formula flash. The big one we talked about today was net present value. Remember the logic, not just the formula. NPV is the sum of the present value of all your future cash flows minus what you spend today. The whole point is to figure out what that future money is worth right now. Understanding that core concept is everything. So I'll leave you with this final question to chew on. For your own business, or maybe a company you really admire, what's the one non-financial metric that it absolutely, positively cannot afford to ignore? The answer to that question might just be the key to its entire future.